When a company raises debt through secured debentures, it must. Here are your options. A. Pledge or mortgage assets as security. B. Offer a fixed dividend to holders. C. Dilute ownership of existing shareholders. Or D. Offer voting rights to lenders. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. Secured debt instruments are backed by company assets that can be claimed by lenders if the company defaults. Such loans do not grant ownership or voting rights. An investor purchasing shares through a stock exchange is participating in. Here are your options. A. Primary market. B. Secondary market. C. Public issue. Or D. Private placement. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. In the secondary market, investors buy and sell existing securities among themselves without affecting the company's capital structure. Which of the following capital providers assume the highest business risk? Here are your options. A. Preference shareholders. B. Debenture holders. C. Equity shareholders. Or D. Bond holders. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Equity shareholders are residual claimants, receiving returns only after all other obligations are met, thus bearing the highest business risk. In which situation would a company's debt capital become a liability on its balance sheet? Here are your options. A. Only if it's secured. B. Always, irrespective of security. C. Only if the company is profitable. Or D. Only when converted to equity. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Both secured and unsecured borrowings are shown as liabilities, representing the company's obligation to repay lenders. The rate of interest that varies according to a reference benchmark is known as. Here are your options. A. Fixed rate. B. Step-up rate. C. Floating rate. Or D. Discounted rate. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Floating rate bonds link interest payments to benchmarks such as inflation or interbank rates, making them variable over time. Equity shareholders receive dividends. Here are your options. A. At a fixed rate determined at issue. B. Only if declared by the company from profits. C. Compulsorily every financial year. Or D. Based on the coupon rate declared by SEBI. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Dividend distribution is not guaranteed and depends on the company's profitability and board's decision, making equity returns uncertain. Which of the following correctly identifies the liquidity benefit of stock exchanges? Here are your options. A. They enable companies to raise fresh capital. B. They fix the cost of capital for the company. C. They determine the coupon rate of bonds. Or D. They enable investors to convert holdings into cash easily. Take a moment to pause the video and decide. The correct answer is option D. Let's see why. Stock exchanges provide liquidity by allowing investors to buy and sell securities quickly in the secondary market. If a company raises ₹100 crore through 10-year debentures at 8% interest, its cost of capital from this source is. Here are your options. A. Fixed at 8% annually. B. Dependent on dividend payout. C. Variable as per share price. Or D. Determined by inflation rate. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. Debt capital has a fixed cost known as interest or coupon rate payable periodically until maturity, regardless of profits. Which of the following best explains credit rating in context of debt securities? Here are your options. A. It measures the company's market value. B. It assesses the ability of the issuer to repay debt. C. It determines the maturity date of the bond. Or D. It indicates the company's dividend policy. Take a moment to pause the video and decide. The correct answer is Option B. Let's see why. Credit rating represents the assessment of default risk by agencies, guiding investors about the issuer's creditworthiness. A firm's total capital is composed of Rs 60 crore in equity and Rs 40 crore in debt. What is the equity proportion in its capital structure? Here are your options. A. 40%, B. 50%, C. 60%, or D. 70%. Take a moment to pause the video and decide. The correct answer is Option C. Let's see why. Capital structure equals equity divided by total capital times 100 equals 60 divided by 100 times 100 equals 60%. It represents the share of equity in total funding. A company paying dividends even in loss years would likely have issued. Here are your options. A. Convertible debentures. B. Preference shares. C. Ordinary equity shares. Or D. Commercial paper. Take a moment to pause the video and decide. The correct answer is Option B. Let's see why. Preference shares promise a fixed dividend, which may accumulate even in years when the company incurs a loss. A company issuing short-term debt instruments for less than 1 year is most likely using. Here are your options. A. Commercial papers. B. Term loans. C. Preference shares. Or D. Bonds. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. Commercial papers are unsecured short-term debt instruments issued by companies to meet temporary funding needs. Why does equity capital generally cost more than debt capital? Here are your options. A. Because dividends are mandatory. B. Because it offers no tax shield. C. Because it is risk-free. Or D. Because equity is redeemable. Take a moment to pause the video and decide. The correct answer is Option B. Let's see why. Interest on debt is tax deductible, reducing effective cost. Dividends on equity are paid from post-tax profits, increasing equity's cost. The main advantage of issuing convertible debentures from an investor's perspective is. Here are your options. A. Guaranteed interest and ownership benefits. B. Immediate liquidity. C. Fixed returns without risk. Or D. Conversion into equity at a potentially lower price. Take a moment to pause the video and decide. The correct answer is Option D. Let's see why. Convertible debentures can be converted into equity at predetermined prices, allowing investors to benefit from future price appreciation. When a company repurchases its own equity shares, it leads to. Here are your options. A. Increase in equity capital. B. Reduction in outstanding share capital. C. Increase in debt capital. Or D. New ownership dilution. Take a moment to pause the video and decide. The correct answer is Option B. Let's see why. Buyback of shares reduces the number of outstanding shares and extinguishes that portion of equity capital. Which of the following best distinguishes preference shares from bonds? Here are your options. A. Both have voting rights. B. Bonds represent ownership. C. Preference shares are debt instruments. Or D. Bonds have fixed maturity. Preference shares do not. Take a moment to pause the video and decide. The correct answer is Option D. Let's see why. Bonds are repayable at maturity, whereas preference shares have no maturity date and form part of hybrid capital. A company obtains funds from a bank by mortgaging its plant and machinery. This represents? Here are your options. A. Secured term loan. B. Unsecured commercial paper. C. Hybrid capital. Or D. Public issue of shares. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. A loan backed by collateral such as plant or machinery is a secured term loan, providing lenders protection in case of default. Equity investors are entitled to the company's profits only after. Here are your options. A. Government taxes are paid. B. Creditors and preference shareholders are paid. C. Debenture holders are issued shares. Or D. All employees receive bonuses. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Equity shareholders have residual claims, meaning they receive profits after satisfying all obligations to creditors and preference shareholders. Which of the following types of capital can result in capital gains for investors if traded profitably? Here are your options. A. Equity shares. B. Bonds. C. Preference shares. Or D. Term loans. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. Equity shares are traded on stock exchanges, allowing investors to earn capital gains when market prices rise above purchase prices. The key distinction between primary and secondary markets is that here are your options. A. Only institutional investors can trade in the primary market. B. Secondary market transactions do not raise funds for the company. C. Secondary market issues new securities. Or D. Primary market allows resale among investors. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Primary market raises new capital for the company, whereas secondary market trading happens among investors without affecting company finances.